Who wants to kick off with the first question? Johnny?
Okay, so when Gareth was sharing his slides, what I found so interesting was the interconnection of the SSAS with the tax, with all the different, with legacy, and all these different elements that somebody would typically be concerned about and try to mitigate during their lifetime. From an accountancy point of view, how would you say that links together?
I would answer it from an accounting and tax perspective.
Okay.
Do you want to just grab that? So when you're speaking, so from an accounting tax perspective, you have to look at what your strategy is. What are you combining the SaaS with? If it's property, it's got certain different rules, or is it a trading business, i.e. where you're selling goods and services, right? So you have to first understand that, right? And then it's depending on what your strategy, whether you then do property and what type of property you do. A lot of times people do loan backs rather than actually owning the property within the SaaS, because a lot of people have a combinations of what they're trying to achieve, right? So I think I did a LinkedIn post today. One of the things that they want to be looking at is, if it's commercial property or service accommodation or furnished holiday lets, can I claim capital allowances?
Yeah.
So you have to think about that, and that is the benefit on when you buy it and you refurb it.
Yeah.
You would, if you had, say, service accommodation or furnished holiday let, you would never put that in a SaaS.
No.
You would put that in a limited company.
Yeah. Okay.
Or an LLP, depending on what you're doing.
Okay.
And then it's how are you going to finance it?
Yeah.
If you're going to do a loan back to buy it, or use that as the money to finance it, then you would put it in a limited company and do a loan back from the SaaS and use that as the security.
Okay. So what you're saying is that if you have a trading business,
Yes.
as a limited company, you can create a SaaS, right?
Yes,
And then if you're doing property, you can do a loan back and work and do both alongside each other by using the loan back strategy.
absolutely
Okay,
correct.
now I understand.
So it depends on what property strategy you're doing. And it also depends on your trading business, on what it's doing, because there's two ways to get security. Security is quite important here. What is being the security? Is it going to be the trading business and the shares of the trading business? Or is it going to be the property in your property company?
Yeah.
Yeah, and it depends on what type of property it is and how you're going to do it.
So if I'm looking to utilize the SaaS in an optimal way, would it be safe to say that it's better to deal with properties that are SaaS friendly? You know, in terms of, because I know that residential stuff is not, you can't really put it in a SaaS.
Correct.
Yeah.
So majority of residential properties, there is some exemptions, like care homes and things like this that are exempt. But most residential property you can't put in a SaaS, so you would buy it in an SPV, a special purpose vehicle. How would you structure that company? That's another important thing, is normally we recommend people to have a parent company.
Yeah.
And then do one of the subsidiaries which does buy-to-lets, HMOs, etc., because they have similar tax implications.
Yeah.
Because you have to think about a number of taxes. There's quite a lot.
Yeah.
And then you can either use it as a loan back and use that as a bridging aspect, because remember, a SaaS lends you over 5 years. And I think people forget that. When you do a loan back, it's over 5 years.
Oh, really? Maximum 5 years? Oh, okay.
And therefore, you've got to pay 20% back every year with interest.
Wow.
So therefore, if you're using that as the sole amount to buy the property, you might find it difficulty because you've got to have cash to cover back the refinancing.
Yeah.
And also the problem is, if you're using that purely as collateral, you can then not get financing on it because the SaaS has to be the first charge.
First charge.
Yeah, it has to be unencumbered.
Okay.
So there's a number of different ways of using the tool. but got to think about the long-term cash flow as well as the accountancy tax.
Okay.
This is why getting advice makes a big difference.
Oh, yes.
Especially from specialists. So I was saying to the gentleman who's speaking before, you've got the number one relationship, accountant tax advisor. And that's not me being biased, it's just simple the fact. Because they are the glue that put everything together. And you need to choose the right accountant tax advisor who understands property, understands SSAS, and understands how to make the cash flow work.
Yeah. So when he was saying, I think it was Gareth who was asking the question, if before you start a SAS, you need to sit around the table with the trustee, the SAS, the trustee, the IFA. You know, we really need to have you as well as clients, really.
Without sounding we're a bit unique in the sense that the IFA for me is only relevant depending on how you're moving the money in and whether you're investing in regulated products like stocks and shares and things like this. Otherwise, the IFA, without being disrespectful, is not relevant to the conversation because property is not their specialty, right? Trading businesses is not their specialty. Then regarding this SAS trustee, that depends on what knowledge your tax advisor accountant has and how involved are they. We provide a whole SAS solution. The reason why, because every corporate trustee has different rules they seem to run on, irrespective to the law. What the law allows you and what the SAS trustee allows you are two different things.
Okay.
Do you see why? So in order to cut all of this, my view, and I'm quite privy to understanding all this, I'm also a SAS trustee. We run solutions.
You're a SAS trustee
I've
as
got
well?
my own SAS.
Oh,
Yeah,
okay.
so, you know, and I understand the tax implications. So depending on what the client wants, depends on who sits there. Another important relationship, you're talking about relationship, is legal person and financing. Because often you need to know those, because as we just stated, depending on how you're buying the property, those are relevant.
Absolutely.
So you're going to need a legal person upon the purchase and to set up the legal agreements.
Yeah.
Property you can't buy without a lawyer who actually knows, who understands these.
Yeah.
You also may need a financing person depending on how you finance it.
Yeah.
Depending whether you're using shares, security, loan backs, where you're sitting the actual asset. And depending on the asset, it can change what decision you make. So there's a lot of stuff. And it's breaking it down and actually having the right people to actually do that.
Yeah.
I hope you're getting value and it's making sense.
Yeah, it makes sense. Well, it's a little bit above my head.
Please.
I'll admit, but every time I listen to conversations about SAS, I feel more inspired and more motivated. But what I would like to do really is reverse engineer the process rather than just going blind. So if I was reverse engineering the process, what is the best way, the best solution for me to optimize a SAS?
Right, to optimize a SAS, first of all is, have you got any business that or linked to, have you got a SAS set up already?
No, I've got a SIP, and in 8 months' time, I'm going to open a SAS.
Okay.
Yeah, and then we'll transfer the money from the SIP to the SAS. It's for whatever reason my accountant is that's the plan. So yeah.
Okay. So when you're transferring it over, first of all, it depends on the value. What range of value have you got in the SIP?
So I only opened the SIP this year. I was told just to open it with very little money because my next tax bill is going to be a bit high. So we'll just, so we're going to sort of pay the tax. I'm a bit worried about saying all of this in public.
Okay, not paying tax. What you're doing is you are planning your family legacy.
Yeah.
And this is so important. From a commercial perspective, it's not just about saving tax, but being tax efficient within the rules and paying the right tax is allowable. This is why you get advisors. Have you got a limited company?
I will do.
Okay, because you need a limited company to be. So I'll give you an example. If you got potentially under 100,000, the SaaS, depending on what strategy that you're doing, may not be a right solution. So you have to look at what you're going to use the SaaS for.
So that's what I meant when I said, wouldn't it be, how can one reverse engineer the SaaS in such a way that I can then be doing the right things from the outset?
So I would recommend, first of all, know what your company is going to be doing.
Okay.
Is it going to be investing in property?
Yep.
What type of property?
So it would be commercial.
Just commercial?
At the moment,
Is
yes.
it going to be doing conversions or just commercial?
Yeah, it would do some development work, so you buy the commercial, you might just, do some builder work to convert it. So the idea being that I want to only do conversions that are SaaS efficient. So if I was going to convert to residential, it would be service accommodation or like care homes and stuff like that.
Yeah,
I can use a SaaS for.
Yeah, but I would be careful. I know there's mixed views on this.
Okay.
But when you've got anything that someone can live in and sleep in, you've got to be careful that it's very clear what it falls under.
Okay.
So from my perspective, number of service accommodation properties I don't believe qualify. That is my professional view, because it really depends on whether it's a hotel or not. So just changing the planning class will not cut it, because HMRC see through this. So if you've got a house on a main street, it looks like a house, whatever you call it won't change it. Right? Care homes are an exception provided they meet the relevant legislation, and that's quite clearly stated. So I would be very careful.
So what about guest houses and Airbnbs, for example?
It depends on what they're classified in and how they are done. C1, potentially, you would need to evaluate it and get that opinion on that. Because what you don't want is to become taxable property and get stung for 55 to 70% and lose your SaaS. My view is when you're converting, a lot of clients I see who convert commercial to residential, they normally use a group structure. So a bit of advice is they have a parent company, the subsidiary, they buy it in the commercial, i.e. the freehold, in the one subsidiary, and then what they do is they split the leases. And what they do is they split it, so the residential element goes into subsidiary B and get tax planning to make sure they minimise stamp duty, land tax, corporation tax, VAT, just to name the key of the taxes. The residential leaseholds go into subsidiary B. Subsidiary A holds the freehold as well as the commercial, and then they sell the commercial element, i.e. on a leasehold, to the pension. That is the most efficient way of doing it, and then you're pulling cash out and you're being efficient and you're getting the best of all the worlds. And that's considered a bit of planning, because there's a lot of stuff you have to do all of those things.
I can see that now.
So this is why you need someone who understands these processes. So I'll give you an example. We've just done a block someone bought, a mixed commercial residential block, for best part of £4 to £5 million. We saved them £1.1 million in tax on VAT, stamp duty, land tax and corporation tax, because we've done it efficiently. And in that case, there's a lot of ongoing benefits of what stays inside, i.e. limited companies, and what goes outside. Another aspect that you've got to think about when you've got property and it's not within the SaaS is something called inheritance tax. So what we suggest and recommend is, when you set up the group company, preferably before you buy anything, set up something called a family investment company. And in order to do that properly, you need a good accountant tax advisor, a legal aspect, and potential financing. If you've not bought something yet, then the financing not going forward, because you need to make sure you've got brokers who will then fund future aspects, because when you've got group structures and family investment companies, finance, you have less access to less of the market. But it's beneficial because you just, earlier you do it, you pay no inheritance tax. Does that make sense?
But I thought that the only way to not pay inheritance tax is to put stuff in trust.
So that's not the full story. So Now we're talking about trust. I love these. I love this. You're getting free things on this, but this is really good. Depends on what trust.
You can see that how my mind is. I'm trying to figure it all out. It's not because I'm getting free advice.
No, but this is the whole point of the event. It's not about the free advice. It's about giving you the access and understanding to be able to make better decisions. Yeah, I just saying. But in the end, you got free advice, right? So it's all good. Right, so if we talk about trust, depends on what type of trust. I'm going to be talking about something called a discretionary trust because that's a common one. That is not correct. It's not like a pension trust, which is a master pension trust, which is dealt totally differently. A discretionary trust has something called a 10-year charge. What that is when you got property or inside the trust or money or value within it, every 10 years you are subject to a 6% charge on it, which is preferable to 40% on death. Yeah? There's ways of managing that, but that's what happens. So it's 6% on the value of the trust. So whatever your gross value of your property, less financing, less something called a nil rate band. So it gets assessed every 10 years. So technically you do pay tax. The 10-year charge, they call it. So you need to be aware of that. So it's not.
So what about those sort of trusts where it only comes into place when you die? So when you die, then the trust is activated. I don't know what it's called.
Yeah, so people use discretionary trusts in different ways. It depends on how you structure the shares in the family investment company because they're normally linked. So what they do is they freeze the value of the current shares of the owners, whatever value they are at the time, and then they put the growth in the shares, but they don't allocate it. That is one way that they do this, and then upon death, they implement the start of the trust, and that's when the clock starts. So you need good tax advice and legal structuring to do that correctly. And they normally have them as growth shares. Growth, yeah, because they split the different types of shares. Freeze the value of the mum and dad, and the growth will be the children or whoever's going to be the beneficiaries of the discretionary trust that you can add at any time. Yeah? So that's how you do it at a high level. But I always, whatever I'm saying here, get advice on your situation because don't say Z just said this and I went and done this, because it's about your situation and how that plans, because you need good estate planning, you need will planning. There's a lot of legal aspects that you have to do as well as the council tax side. Yeah, and there's tax returns and all the rest of it you have to do.
Okay.
So does that help?
That's very helpful. It's, again, I was saying to somebody this evening that I've been coming to SSAS London since the summer, before the summer, and everything was just too much. I didn't really connect with it, but today I'm sort of like beginning to see through the fog.
Have you also looked at something called Opco Propco, which I did a presentation to SSAS London?
Did, yeah.
Have you watched that video?
Maybe I need to watch it again.
Watch it, because that will change you how to structure as well.
Okay.
Because I noticed, if you notice, we spend a little bit of time since we got a lot of love happening here.
Sorry, I'm not even looking at the camera.
No, don't worry. It's good questions. So when you set up, get the initial advice from a specialist in this area, because depending on your strategy, you've got potentially 3 types of propcos which hold the property, whether it's commercial. I'm clearly articulating commercial property, service accommodation, or furnished holiday lets, because they are quite relevant to what I'm about to say in Opco Propco. They are treated different from HMOs and buy-to-lets. So they have different rules. So that's why I'm talking about these 3. I actually done a LinkedIn post a bit about this just today.
Oh wow! Right. So I'll look out for that.
Yeah, so I talked about Opco Propco, and the reason being is your Propco can change depending on a number of different factors. You can have LLPs as your Propco, and you can actually earn £1 million tax-free still in the UK at the time when we're recording this in 2023. Don't you love the UK tax system? Right? Or you can use group structures for limited companies, or you can use SSASs if it's commercial property or a qualifying property which is not taxable or considered residential property under the pension legislation. I emphasize that. Please do get professional opinions that are valid on whether the status of the property, because if you don't, you could get yourself in a lot of problems, as I mentioned earlier. It's not a broad brush, but commercial property works quite well with this, and depending on different variable factors, you can change the prop code. Does that make sense? And then you can set up the opco prop code. Yeah, a lot of people do. And then they set up agreements, because operating the business, they split to owning the property. And there's huge advantages, because you can get a number of benefits, which I did a detailed presentation at SSAS London to this, and something worthwhile watching. And we'll put the link in the comments. I'm looking at Alfie, he'll do that.
Okay, fantastic.
Yeah? So that's how you can potentially look at that.
Yeah.
I know that we've gone through a lot, but you can see why, depending on your situation, there's a lot of variations.
Yeah.
And we just talked about tax, not the accounting implications, the business leverage that's required, and also the options of refinancing through pensions. Because they are all different, and you need to make sure you get all of the jigsaw put together. Has that been useful to you?
Very useful. Thank you so much.
Have you got more questions? I love it.
No, not yet. I'm going to digest everything. Maybe next time.
Absolutely.
More questions.
No, absolutely. And do you know what? The questions that you're asking, the audience, we've got a huge following on LinkedIn across the piece. There's the questions they ask.
Oh, fantastic.
And we've also done episodes on Sky TV. You can see them on YouTube around how pensions can be used. We've got a number of guides that you can use. Also how property investment works, how property development works, and in relation to other trading businesses where people are doing consultancy, and how they can utilize all the different aspects and not get stung by the dreaded inheritance tax, capital gains tax, stamp duty. The list is quite long. Does that make sense?
That's lovely.
So hopefully it's helped you with your journey and given you some knowledge and why you need to probably engage a specialist before you make a decision on the different aspects.
Yeah, lovely. Yeah. Thank you.
Thank you so much.
Thank you.
So, on a different perspective, how do you find SSAS London?
I love it. It's completely different from any networking meeting I attend, and I like the fact that it's new learning for me. And before I came to SSAS London, I didn't quite appreciate the advantages of using a SSAS. So it's legacy friendly, it's tax friendly, so there's a whole range of different pluses. Obviously, you need the right advice and you need to do it correctly, but yes, it's very interesting.
And I think you've raised also, it's very fortunate. And Alfie, if you could just do a little twirl and see all the different people that attend. Attend the event. We've got a number of different experts in different parts, and they're here to help people and make them make better commercial financial decisions.
And you need to, all of these people are relevant to the tax.
Absolutely.
So that's the really fascinating and interesting thing about it.
And many people follow me. I'm a huge fan of how that works.
So how does it work with accountants and tax advisors with SSAS?
Really good point. So you need to understand or get people who understand, right, first of all, what type of business you've got, right? So we're assuming this is a property business for this because, right, so you need someone who understands property accountancy because accountancy has its own rules and property has specific rules in itself. That will really help you. And you need a tax advisor who specializes in property. And the reason why is because very few people do both. And they need to be, if you have two different people doing this, for example, you need to have them being able to talk to each other. And if you've got a tax advisor and they are not also your accountant and they don't specialize in property, they need to be able to liaise, and the property accountant needs to be able to implement quite a lot of the stuff, because a lot of stuff will be on an annual basis.
Okay.
Yeah?
Will that be tied in with your tax returns or
Potentially.
different dates?
Potentially, depending on what you're doing.
Okay.
Right, so certain restructuring, you need to make sure that you've got the right stuff done from a tax perspective, whether I'm going to use some technical stuff here, if they have something called tax elections that have to be done, because when you do certain movements or certain restructuring or you move property around, you need to take certain reliefs and exemptions for stamp duty, land tax, corporation tax. VAT has certain aspects that you've got to do. So these are the common ones. There's also special taxes in property if you own residential property. It's something called ATED, right? If you've got residential property in a limited company over $500,000. So these are the things that they need to be working on a continuous basis, because they have different deadlines, different requirements. Yeah, and they need to liaise with your lawyer, because certain things that accountant tax advisor can't do, only a lawyer can do, i.e. buying the property, making sure you do deeds of trusts, for example, when you're moving property around in groups. Any beneficial ownership movements, if that is relevant, depending on whether you're moving from incorporating, for example. So there's a lot of different things that you need to do and get advice, and make sure your trusted advisor, which happens to be your accountant tax advisor, they are leading that to make sure they've got the relevant individuals involved. Also, another very important person, and I'm not limiting it to these people, if they say Z forgot me, is a financing or a commercial or finance broker, because they need to know what is your financial strategy around how you're going to get cash into it, especially if you're leveraging or you're going to leverage going forward, because you will not always get the money from a SSAS. Normally your tax advisor will liaise with your corporate trustee, or they should be, for your SSAS pension if you are using that as a tool to finance. I know that sounds like a lot.
Just one more question.
Oh, please.
While I have your
Yeah,
audience.
no problem. I love how she put that. Made me sound important. I love it. I am not really.
There's been all this talk about landlords who did their transfers to LLP structures and how HMRC is not happy about it. What are your thoughts on that? I know I'm veering slightly off topic.
Really good question. And I want to be careful without mentioning certain people, because they get very upset, especially when people like myself mention them, because there seems to be a bit of a private members club going on with some of these gentlemen or ladies, right? Talking about the specific aspect which Tono has raised is something called mixed hybrid LLPs, which HMRC quite rightly have issued something we call Spotlight 63, which basically says they believe it's a tax avoidance scheme. And many will know I'm not a huge fan of HMRC, but in this case, I think they are correct. That is my view on this, and everyone can take their own professional view. And the reason why is because they've already had legislation put in for mixed LLPs and how they work. And I don't want to get into the specific organisation who has done that. That is their job to defend their things with HMRC. But my recommendation is professional advice on before you do incorporations and you do certain types of planning, because certain ones clearly don't work, and many of the profession are in agreement, not everybody, on what works and what potentially doesn't work. There's other solutions we have difference of opinions on. And right now, I go by the date we're doing this, and I believe it's 18th of October when we're recording this 2023. And at this time, we go by what is being highlighted by HMRC. And ultimately, it is not just HMRC, it will be the court structure or legislation that will enforce this ultimately, because they are the ultimate outcome. But I would always recommend, if HMRC believe and they raise a spotlight, you must be 100% sure and have a relevant tax advisor or KC, which is King Counsel, barrister opinion, to prove otherwise, and be willing to believe that before if you go against it. I would suggest on 99.9% of cases not to go against it. That's my view. I hope that's answered the question.
That's perfect.
Yeah. And that was a really relevant question, what's happening in the world. And one of the things I think really important when you decide on your advisor, that number one, they're not slinging mud on other advisors, because that is not professional courtesy and not professional ethics. Secondly, we should only give advice to our clients, in my opinion. Right? And I think I know a bit about what I'm talking about, but I'll leave it to the public to make their opinion on this around certain tax, accountancy, finance decisions of what you're, as an entrepreneur, that you're taking. Make sure you get the right trusted advisor and make sure you do due diligence. That is my advice and suggestions on this. I hope that makes sense.
That makes a lot of sense. Thank you so much for your time and your knowledge.
Thank you.
I really appreciate it.
Thank you. And it was a bit of an additional question, but I think it's quite relevant, and I do think you do need to invest time and knowledge, because it is difficult for the average entrepreneur who's trying to do the right thing and is getting conflicting views on different aspects. So it's right to ask for clarification. Is that okay?
Lovely.
Thank you. Hi, we've got Abdul here who wants to ask some questions, and we're going to help him hopefully with some answers, depending how tough his questions are. Let's see, he's going to be asking me quite a few. So Abdul, I hear you're new to the property world?
I am. So currently setting up, looking for some properties. My strategy is to buy one beds, convert them to two beds.
So, okay.
So I'm looking around the commuter belt around London.
Before you start, a quick little clarification for the audience. Okay, are you going to hold the property or sell it?
Ideally, I want to sell.
Okay.
But in the event I can't, I'll refinance and onto a buy-to-let.
Okay. Just to let you know, that's huge tax implications. Just to give you a bit of my background, I don't know if you know who I am. I'm on Sky TV, done a lot of presentations around property, advised quite a few influential people in the property world, and happen to help a lot of entrepreneurs around structuring, accounting, tax. One of the things, we specialise with tax on SSAS pensions, as well as limited companies, property taxes, as well as trading businesses. One of the most important things is differentiating between a property investor and a property developer. If you haven't seen this, I do some detailed guides, and we've done some detailed guide videos on this. If you are buying property to develop it, i.e. add value, to sell it, you are considered a property developer. That is treated totally different for tax compared to if you're getting a property, adding value to hold it for rent. You are then a property investor. I would recommend highly to make the decision at the beginning, because you may have certain implications that you did not expect or thought about in the longer term. Does that make sense? So, because there's a lot of taxes impacted by this. So first thing would be making the decision on what you're going to do and trying to stick by that, and then getting the right structure to suit those decisions, and make sure you structure. So don't let the tax lead it. Make sure your property strategy is the leading factor, and then structure using it by reverse engineering. Does that make sense?
Yeah, absolutely.
Okay. More questions? I'm sure you have them.
Okay. So ideally would be to be a developer. Then in terms of doing it through a limited company versus personal, I know there's more tax implications by personal.
From my perspective, really good question Abdul's asked, and I'm sure people have heard it, is what structure do I use if I'm a property developer? And I've got a detailed guide and a whole Sky TV episode on this, which you can check it out as well. And Alfie, have you put it in the links? There's a few links in there. And we've got guides. You would put, ideally, in a group structure, parent company, subsidiary. There's a reason for this, because you've got special rules for capital gains tax and inheritance tax. And I would recommend that you really get good advice around structuring at the beginning before you acquire the property. And I assume you're buying residential property to add value. Yeah.
In the long term, it would be to go to commercial conversions.
Oh, my favourite area.
That's going to
And have you met a good friend of mine and who we're accountant tax advisors called a gentleman called Ranjan Bhattacharya? He's king of commercial property. The gentleman runs Baker Street Property Meet in London. And he's got a lot of videos around commercial property.
I recognise it. I think it was on Sajid podcast recently.
Sorry?
Was it on Sajid?
Yes.
Yeah,
yes.
I recognise it.
Yes, he's on Sajid Sain's thing. Really useful to invest in your knowledge around the property strategy, because you have to know what implications, because it's not just accountancy tax. It's understanding the permitted development rules, planning, very important. Invested a lot of time learning those, because you get huge value if you understand those and you understand how to use group structures. You also change the ball game, because if you're an investor now, it sounds like what you're going to do, potentially to keep the asset, you bring a lot of tax advantages that you may not have if you're a property developer. Number one, there's a gentleman over there called Usman, who we work quite clearly with. Alfie, do you want to just do a little rollover with the camera? Over to Usman, who's over in the table over there. One of us on the power team of SSAS London. You may see him. He's an expert on capital allowances. Capital allowances, and if you watch my LinkedIn post today, I mentioned these, are one of the rare benefits left in the UK tax code, which you must take advantage of if you are a property investor. If you are a property developer, you don't get this. This is one way you can actually earn, still, as I mentioned earlier, in the UK, up to £1 million tax-free on the purchase of the property. There's also refurb benefits as well. So getting the advice and understanding this can make a huge difference. I hope, Abdul, this is adding huge injection. Hence you'll learn why a lot of people love listening to some of our stuff. Well, I hope that's what they tell me. I don't know if they always believe that. Thank you. I love this stuff, because entrepreneurs, I find one of my missions is I'm an entrepreneur that happens to have one suit, that is an accountant, tax advisor, business advisor, is making a big difference to the journey. And ultimately, in order to grow your legacy and wealth, you need right advice, the right people behind you to make the difference. And I think I suggested earlier in the video some of the key people, but there is many others depending on what strategy you're doing. Yeah, because one of your strategies you may need a good planning consultant, because permitted development isn't as easy as people think. It's not just the 56-day rule, as people say, right? There's a whole checklist. Invest time in that. Understanding VAT, group structures, leasing, freehold, leaseholds, SSAS pensions, group structures, LLPs. I think I mentioned in one of the videos of OpCo, PropCo. All of this fun. Make a huge difference. And this is specialist knowledge. I keep on saying, please, 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 make sure you get good advice. It can make a difference maker, and it can compound your entrepreneur journey to get to what I love talking about on my podcast, is unlocking financial freedom. I know John Howard and Ranjan love that anyway. Is there any more questions?
That's everything for me.
Perfect. And what property strategies are you looking at on, apart from commercial, property development? Are you looking to invest in buy-to-lets and HMOs at all?
Not as of yet.
No?
Maybe I was contemplating the service accommodation route. Maybe some buy-to-lets, but I'm thinking for capital appreciation, maybe London. That would probably be a strategy for me. But I wouldn't say it's a primary focus for now. Maybe I can flip that around.
I think a good question, if you don't mind me saying, is the difference between, I think I mentioned earlier, service accommodation and buy-to-lets HMOs. I would recommend, depending on your turnover, to have them in a different element in a group structure, because our friend VAT is a big issue here, and many people don't understand that, and they're getting themselves into a lot of problems. So again, get good advice. And I'm trying to explain to people, because many people don't understand. So service accommodation or holiday furnished lets, they are slightly different but similar. That's short-term lets, i.e. preferably let then 20, 30 days or for corporation tax or VAT, it's 28 days and less. It changes the status. Make sure you know that to something longer term let, i.e. more than that or over 6 months, because they have different rules. Yeah.
I do have a question actually.
Oh, love it. Go on.
So, potentially going to relocate in the next few years to the Middle East. I'm thinking maybe Qatar. How would it work?
Where are you going to relocate?
I'm thinking of Qatar.
Qatar. Got a good friend out there. He's been out there a long time.
So I'm thinking in terms of tax residency, how would that work with UK and...
Love this question. Don't get asked this as much as we used to. Dubai's been a good thing. You've got a number of things here. Property has special rules, right, in UK. So what happens is, depending on the limited company you got, you will still pay tax on a corporation tax perspective. Then it will look at being a non-resident and the resident rules of Qatar. Depending on the tax rates, i.e. personal tax rates in Qatar, and whether you are non-resident in the UK, that will change your requirements. You could be a non-tax resident in the UK and be a tax resident in Qatar, then you will follow their rules. But property isn't like a trading business where you can move the status abroad like you can do if you're selling goods and services. You are still going to be taxed in the land where you hold the asset, yeah, for corporation tax. So very clear. And then there's something called the statutory residence test and the automatic overseas test, as well as the UK test. I'm going to give a bit of an overview because it's quite complicated. Please get your own circumstances because there's so many variations. But if you generally live more than 183 days, you will become a tax resident in the country that you are. But there is historical tests as well, where you've been a few years before, how many days you're coming to the UK, whether you are tax resident of both areas. I was asked this on Sky TV. I would recommend you watch that episode when good old John Howard was like, don't you know all the tax laws around the world? As I said to him nicely, I can't be that confident. I know the UK tax laws. You need to get advice in the country that you're in around the tax laws in that country, as well as the UK. We advise on UK tax matters. Does that answer your question? Yeah, very important planet. Yeah, and also when you are going to come back. Sorry, another point. When you are going to come back to the UK, there's a 5-year implication. Very important. If you come back off within the 5 years, you may pay income tax or capital gains tax in the UK of anything that you sold in between while you've been abroad. Be careful. And there's a lot of tests. So get good advice, get an evaluation before you take actions, even when you're abroad, if you've been a UK tax resident before, which I know you sounds like you are, Abdul. Has that been useful?
Yes, thanks so much for your time.
No problem. So, really good question. Abdul was asking around, and Ronald, who asked it off air as well, is around financing, which I did mention earlier, is group structures. You do get less people potentially financing, but there is a lot of specialist lenders, just like specialist accountant tax advisors. Another issue that I suggested, why do you need specialist advice? It's not just from a business advisory perspective, because that's what I consider that question under, is your tax aspects are so specialist to your particular case. I had one today, funny enough, around someone's bought a piece of land. Land is again different to residential and commercial property. And how do you move that around to make sure you protect a developer and an investor perspective and their legacy? So Abdul, I was saying, every case you must cover with specialist advice, and we come to a solution that's going to mitigate quite the big taxes and be commercially available. There is a lot of what we call a technical word, tax elections that are going to need to be done, stamp duty, land tax returns as well to move that property, and a lot of legal work. But if that person got advice before he bought the property, he would have been in a much better, and he would have saved professional fees. I may be doing myself out of a job, right? But he now has to mitigate that solution that he's got into. Additional implications could have happened if he was registered for VAT. So we call it opted to tax, but that's being registered for VAT, because you can do that with land. And if you're developing, I highly recommend that, preferably after you've got the advice, because you could trigger something called partial exemption VAT, and God help you because it's very complicated. And you, with land or property, you have to get agreement with HMRC how you do the partial exemption VAT. It's not like goods, which are dealt with under the standard tests or the quick tests that are already in the VAT Act 1994. I know I'm spouting it out, but they're different rules, and you've got to understand that every situation's different. So please get the advice. So I was just trying to illustrate why getting the advice before you buy stuff. We didn't mention, and I do mention this, and this is from your question around commercial property. Everyone loves commercial property these days, including me. Before you buy the commercial property, make sure you get something called the CPSE, Commercial Property Standard Inquiry Form, reviewed by a tax specialist, and make sure your lawyer gets you that. That's going to save you in probably at least 3 different areas, or 4 if I add a few other things. 1, stamp duty land tax benefits. Number 2, VAT benefits. Number 3, corporation tax benefits. And number 4, structuring benefits. Must get advice. If you don't, you are going to lose a lot of money and a lot of pain. I think we had additional aspects. Was there any other questions for you? Perfect. Love it. Thank you. Hi everyone, we've got one of my very good friends here, Usman, who I love talking to, and he adds huge value. Usman, thank you for going to answer some of these questions and these scenarios. If you don't know about capital allowances, I've been going on about this. I did even a LinkedIn post today on some of the benefits. This is the gentleman that you've got to have part of your battle team, and make sure your accountant, tax advisor who specialise in property works with this person, and make sure we structure accordingly. Usman, thank you for coming in and answering a few questions. And I was just speaking to a client before, and I was saying to him, or potential client or a potential entrepreneur, that when they buy commercial property, service accommodation, furnished holiday lets, and the list is quite long, I'm just naming those to be ones, they must understand or get from their accountant tax advisor an understanding or an intro to someone who understands capital allowances. Is that a fair reflection on this?
It's probably one of the biggest tax breaks for any commercial property investor that they need to be taken advantage of. And the biggest issue we have is, like you said, raising awareness around the subject, because just not enough people know about this lucrative tax break and all the benefits that it entails. It ultimately makes any commercial acquisition that you're looking to invest in that much more viable if you're able to retain your income for at least the first 3 to 4 years and not have to pay any tax, is what we're looking to do. And that's what we do. We essentially allow you to retain all your income for the first 3 to 4 years as a bare minimum, and make that transaction that much more viable, keep more money in your pocket, more money to reinvest in the business, invest in other properties. Win-win.
Excellent. And I know he's adding huge value to this process and doing by step. One of the things that is really important is to break it up. Sorry? What? What's that? Yeah.
To get my jacket.
Oh, sorry, am I sitting on your jacket?
Bag's down.
Oh no, sorry buddy. Absolutely.
That's my jacket. That's my jacket.
My bag's there, sorry.
Okay.
No, I moved my bag there. I moved my jacket over there.
No, that's all right. No problem. No problem.
Alright, okay.
No problem. No, nice meeting you. No problem.
Cheers. Thank you.
Don't you love SAS? And even myself, we get people. I'm sure I checked my jacket, but it's all good.
Worst timing ever.
Let's go. I'm sure Alfie will do some magic, and my team will do the magic to continue this on. Right, Usman, we're asking. Usman packs a lot of value, and I'm going to try my best to break it up, because what he was quite stating is, depending on what you're doing, you can get a lot of tax-free income, whether it's against your company, therefore save corporation tax, or if it's in an LLP or in your own name, save income tax. And it's so important to get that advice around structuring, and then making sure on 2 parts. And I want to let Usman explain this a bit. I'm going to start number 1, the purchase. And this is so important, isn't it? When you buy commercial property, service accommodation, furnished holiday lets, getting advice on the purchase.
So essentially, with a purchase, so I mean, if you're doing serviced accommodation or you're doing something like supported living and you're buying a residential unit, perfect, because it's a residential unit, you're bringing it into commercial use, you're the first person who's entitled to claim capital allowances, blank canvas, we can claim straight away on the purchase price of that property as it is, whatever state it's in, as pre-trading expenditure to the business of serviced accommodation, furnished holiday let, or supported living. However, if you are looking to buy a bona fide commercial property, say an office or warehouse, care home, restaurant, hotel, there are rules, there are restrictions, there is a fair bit of due diligence that needs to be done, which is why we need to be contracted in essentially at point of exchange or as early as possible the minute you're looking at the property, because ultimately we have to put some clauses into the contract. We have to essentially retain your right to claim capital allowances upon completion, and that's the biggest thing, because if we don't do it properly at the beginning, if we don't get it right at the beginning, we potentially lose those allowances for the lifetime of that property. It could be massive.
As you'll see, Usman reels it off because he does a lot. So I'm going to break a bit down on that, if that's all right, Usman. And I love this. He differentiated a bit of income of commercial property and service accommodation, furnished holiday. And I'm going to explain a little bit, and I'm sure Usman will give his view. The reason being is it depends on what you're going to do with that property. Because furnished holiday lets and service accommodation for income perspective, whether it's corporation tax or in your own name for income tax, is considered trading income, and they are treated differently. When it's commercial property, the reason why there's some caveats and why you need to make sure you structure and know what you're doing is the capital allowances can be restricted if it's not used for a commercial use post acquisition and have income to offset it. Very important, because a lot of clients we've seen don't understand this and they get themselves in problems because they get the capital allowance work done and then they come and see a specialist and they're like, hold on mate, you haven't broken it up. So that's what Usman was referring to. Another area that he does unbelievable well is, and I know we got good old friend Jeremy in the budget, is the refurb. And I'll go on about this. There's the purchase for capital allowances and there's something called refurb. i.e. when you refurb, tell us a bit about the fully expense at the moment.
So, essentially, there's a lot of information there that Z just covered. Ultimately, with regards to trading income, rental income, and the different rules, that's stuff that me and Z will take care of. So, the complications of that, we don't want to delve into too deeply because that's what we're here to do. As far as you guys are concerned, the only thing you need to be aware of, if you've incurred qualifying expenditure buying a commercial property, refurbing a commercial property, there are allowances that you can claim on that you're entitled to, and we will wipe out your tax bill. That's what value we add. Now, you've got a purchase claim that we can claim capital allowances from, we can strip that out, and then you gut it, and you complete a refurb on that property. There's a second claim to be made there, a double whammy claim. So we can claim on your purchase price and your refurb cost and pool both those amounts to form one overall massive pool of allowances that you can utilize against your income tax bill going forward, against your profits. And that refurb that you've done the property will be more valuable than the purchase, because literally everything in the refurb potentially qualifies. There'll be a significant claim and a significant percentage of that expenditure that we can claim back as capital allowances.
Absolutely, and I'm just going to add a little bit aspects to this. Why do you need an accountant tax advisor and why do you need a capital allowance specialist? I'm going to break that down quickly for you. The accountant tax advisor will be your point of call initially to make sure that that's not forgotten and it goes in the right favour. Then you need a capital allowance to do the work and identify what allowances are. Your accountant tax advisor won't be able to do that unless they are a surveyor, which 99.9% last time I checked on. And that's where Usman comes in. He does a detailed report, which is what your accountant tax advisor needs post that to be able to claim it. That's the step by step. And therefore, if you don't do these steps, you lose out a lot, because there's certain things you can claim in this journey and there's certain things you can't claim. And this is why you need that team of step by step. I hope that clarifies. Have I done a fair reflection?
No, that is essentially it. It's worth pointing out the types of things that do qualify to claim capital allowances on. So if you're buying purchasing a property, the types of things that we claim capital allowances are things like the incoming mains, water, data, gas, electricity, the wiring, the switchgear in the building, the flooring in the building, the lighting, the heating, the ventilation, the kitchenware, the sanitaryware, the fire alarm system, the CCTV system. All of this stuff needs to be quantified, and that's what we do. We're identifying these items that are embedded throughout the property and putting a value based on the purchase price and the expenditure that you've incurred. And these are the things as specialists we're adding value, and we're identifying these things that are often missed by accountants because it's just a detailed subject, and that's what we specialise in, and that's all I do. and that's the value we're looking at. And every commercial property has those items in it.
Absolutely.
Every property, whether it's dilapidated and the stuff's hanging from the rafters, we can claim it. We'll claim all of that stuff. So there's so much value to be had. Even when the account says there's nothing of any value, there is so much value. When they say we've claimed everything, they haven't claimed anything. There is so much stuff to claim. So always get a second opinion, always get specialists involved. Contact Z, contact myself. Happy to answer any questions. Desktop assessments available at your request, and we can get this stuff done.
Just to add to what Usman done, because he reeled off quite a lot, and Usman's so passionate about value, and he gives you so much aspects. To break it down, get a time of acquisition, get the right support during your journey, make sure you get the relevant stuff done. Also, make sure you get an expert opinion, which he was referring to, because certain people who don't specialize in this, whether they're accountant tax advisors, may not be aware of this, and they may miss that, and it's not down to they're doing it on purpose or anything like this. It's because it's a specialty area, and this is why having that expert opinion or making sure they work with the right people makes a huge difference. So just make sure you get that and structure it by step, and the value is huge, as I keep on telling people. Right now for acquisition, right, you have something up to £1 million, something called an annual investment allowance, and I'll be technical. You can potentially claim, and there is some other reliefs you can claim as well. But when you refurb, which I was saying to Usman, is something called fully expensed, which good old Jeremy has made unlimited at the time of this recording, which is quite big. So make sure what qualifies, what doesn't. This is where Usman does his magic and makes a lot of people very happy. Big Cheshire Cat smile, because there is a lot of things you can do. I hope that's made sense. If there's any questions, put them in the comments below, and we're more than happy to help and get individual assessments, evaluations done if required. But I hope you got value for watching this, and please do like and comment, because we love understanding what value we can give. I hope that made sense. Thank you, Usman.
Okay, good stuff.
Perfect. Hi everyone, got another person who's attending SSAS London here, and he's a property sourcer stroke property investor. Hi Paul, thank you.
Hi, thank
and
you.
I've obviously we connected on LinkedIn.
Yes, we
Part of
are.
the LinkedIn family that I talk about. And I noticed one thing from our last conversation, Paul, is that you've been really active on LinkedIn. How are you finding it?
To be honest, I'm finding it very interesting. I was very shy before on social media. I didn't like to post anything, but now I know that closed mouth don't get fed. So yeah, I'm quite out now on social media and to promote my business as well.
Fantastic. And one thing Paul took place, we had a little conversation, didn't we, when we started, and this is probably the first time he's recording stuff, so he's a bit shy about it, but I said to him how he took action from our conversation. He started actively commenting, posting on social media, and tried to build relationships, and you built a number of connections and followers now.
Yes, I have. I think you're one of them as well.
Yeah, I love him, and you've commented on my post, so I'm really appreciative. These are the people that really make a big difference and make people like myself really want to post and motivate ourselves to do more, because this is the audience that make the difference for us in the longer term, because they actually go in action and they get benefit, and that's the whole point for me, LinkedIn. A couple of things you were asking about the tax benefits around, or how to structure for sourcing, and if he's keeping the deals for property investment. What I suggested is, if he's sourcing the property deals for other entrepreneurs and charging a sourcing fee, that's considered a trading business. I would keep that in a separate entity. And then he has to look at is how he recycles the money, whether he uses a group structure, a parent company on top to move the money around, to loan it to potentially a property investment business. Then it comes down to, if he is securing a deal to hold the property, what is he using as financing, right? And then what is he going to do with that deal? Is he going to keep the deal, right? Or is he going to sell it after doing the refurb work and that? So if he's going to buy the property with investor finance, structure it probably using a JV, a joint venture.
joint venture, yeah.
So they get an equity split as well, and then he's going to sell it. Then he's considered a development business, and therefore a property developer, a trading business, and you make sure you have it in a trading business structure. Huge benefits from potentially substantial share exemption. This may go up to a technical, and also for the person investing, investors relief. Also, you could get entrepreneurs relief if he wants to ever close it. These are really important reliefs. If he's holding the property as an investor, he wants to make sure he structures it in a family investment company. The reason being is because he's going to get rent and hold the property, and he wants to make sure he protects against inheritance tax going forward, and any benefits that will give a big one, 40%, and potentially protect his legacy. So these are really important. Hope this is good benefit. Cool.
Yeah, thank you very much.
Is there other stuff that you're looking at, or what you're looking to get right now? Because I know you're active part of SSAS London, and we love that.
Yeah. Actually, what I'm doing at the moment, I have a project that I have in northeast of England, which I am is a 4-bed property, converting it to 6-bed. So I am looking for finance for the next one.
Okay.
As my money will be running out very, very soon. So I am looking at giving someone some return on investment.
Okay.
Maybe better than what they are getting from the bank.
So this is a HMO, right?
It's a HMO.
Is this HO? The HMO is a house of multiple occupancies where he's got 6 rooms, did you say? And you're
6
gonna,
rooms.
And you're going to go, is that what you're going to get to, or you're going up to 8?
I'm gonna go up to 6, but seven persons.
Okay. So planning, depending on where you are in the country, make sure you got a HMO license and all the rest of it, and make sure you've got the right planning classes depending on where it is. Is this in the north of England?
Yeah, it's the north of England.
Okay. And I guess this is what we call the BRRRR strategy, I guess. So you're getting something below market value, refurbing, potentially refinancing, and buying out the investor with a agreement to give them an uplift.
Exactly.
Excellent. So Paul is looking for investment in his deal. I'm going to tag him in. So do liaise with him to see if you can help him and hopefully potentially benefit, and make sure you do due diligence from a perspective before you invest in any deals. And Paul will obviously explain what he does and how he works with people. But I hope that helps, and hopes you get benefit when visiting SSAS London, because so many property entrepreneurs, don't you love SSAS London? Thank you for enjoying that. Is there anything else?
Yeah, actually, I have one more question.
Oh.
This is about my son.
Okay.
He's 18 years old.
Right, okay.
He wants to get into property. So the question is, how do we structure that? Does he buy on his own name, or should we form a company for him?
So this comes back to, what are you buying? Are you going to buy properties to hold for rent, or are you going to buy properties developed to sell?
It's for him to hold.
For rent?
Yeah, for rent.
So what I would suggest is what I was saying earlier, have a parent company, which would be a family investment company, structured in the right way. Then it depends on how much money he's going to invest, whether you want him to take shareholding now with potentially dividends going to him with different potential share classes. Also, I would protect if you are investing in it as well, whether you and if you are married and things like this, if your husband and wife are investing, and who he's going to invest, depending on how you protect against future growth. So there's a few facets that you do. I would recommend you get that done first of all. Then the second question is, how do you introduce capital, i.e. cash, into the business? I would recommend that you do it for something called a director loan. If he's a director on the business, because he's 18 and over, you can actually be director at different ages, but shareholders tend to be 18 and over. I would then set up a loan to the company. There is some tax benefits of doing that way, because you can withdraw that money later tax-free. Also, potentially, depending on his income, you could charge interest to the company on the cash and do that tax efficiently. You would always get professional advice from an accountant, tax advisor who understands what I've just mentioned.
Thank you very much for that.
No problem. Is there any more thing?
No, but if I get anything else, I'll just shoot it on LinkedIn.
Yeah. No problem. And it's really important to do that, and hopefully this helps Paul's journey and other entrepreneurs. We love this stuff. Thank you for listening. It's Z. Ronak wants to ask some questions. and he doesn't want to be on the camera, which is all good, but he's got hopefully some nice questions. Hopefully I can answer them. I'll do my best.
Yeah, thank you, Steve.
No problem.
So it's a quick question around stamp duty, SDLT and CGT mitigation, and specifically to structuring around a title split.
Title split, just to clarify, what type of title split? Is it mixed commercial?
No, it's residential, so purchasing a freehold,
right?
Then getting planning to convert a residential into multiple flats, without then obviously triggering any SDLT or CGT in the transfer between freehold and leasehold, which are ultimately owned by the same controlling entities.
Okay, so this comes down to structuring how you deal with this. So the way you do this is you have a parent company is quite important in this.
Yeah.
If there isn't a parent company, you will need to get non-statutory clearance and do something called share for share exchange, get that set up. Depends on what you bought it in. Have you bought it in a subsidiary or?
This is not bought yet, so let's just say you're purchasing the freehold in one company.
Right.
As it currently is as a unit.
I would, if I could do end-to-end on
absolutely,
this.
Please.
So I would get a parent company, set up,
a holdco,
and then set up a subsidiary and buy it in the subsidiary, the freehold.
Okay.
Right, because at that time it's not being split. So you're trying to get an uplift in GDV on the split of the property and get the individual value. But what you do then is, if you have a subsidiary B set up, you then do the split leases, because no lawyer will allow you to do it in the same entity.
Correct. Yeah.
So you've got a legal implication and you've got a potential tax implication if you move it. But if you do it within a parent group, right, I would recommend your tax advisor working with whoever your lawyer to give you written advice. I'm just giving this as an overview because everyone's circumstances can change.
Correct.
Right, and it could be potentially, depending on what you're doing, that implications on their history and all the rest, depending on what was there before and what you've done. You use group relief to claim to put it in subsidiary B, and therefore you pay 0 on stamp duty, land tax, 0 on corporation tax, because in groups and limited companies you don't pay capital gains tax, you pay corporation tax. I hope that's answered the question.
Yeah, and then when you transfer it from the freehold to the leasehold, you then have the
No, you do the split. When you do the split, the leasehold is split into subsidiary B by the lawyer, and therefore you claim a transaction within the group. And the group has to be set up in the correct manner.
So you're saying the original purchase is in the holdco?
The shares are held in the holdco.
Yeah.
The subsidiary A buys the freehold,
and then the
subsidiary
B
the freehold. And when you split the leasehold into leases in the different components, after you've done what you need to do, you do that. Or maybe before, depending on how much value uplift, you then do that split all on the day to put into subsidiary B. And that's where the legal splitting, you will need to do a stamp duty land tax return on the different aspects, claiming the relief, and you have to then do a bit of accounting behind that, as well as corporation tax. And then refinance after my recommendation in the new bit where the GDV has been uplifted.
Yeah, and then also you hold it for 2 years, don't you, in the...
What are you talking about in holding for 2 years, just to clarify?
You hold the splits in subsidiary B for 2 years, don't you,
for what reason?
For mitigating any SDLT.
No. So what happens is, if what you're talking about is degrouping, right? I would certainly recommend being very careful, because you've got 2 major taxes. When you've got a subsidiary and you moved and you've got a benefit of a no gain, no loss aspect, that's what you've done, right? That's the part of the process and the reliefs. If you decouple the groups or degroup, whichever way you want to call them, and I'm sure there's advisors watching and saying, see, this is the different words, right? There's different implications for stamp duty, right, as well as stamp duty land tax, as well as corporation tax from a capital gains tax perspective as well. right? The legislation sort of mirrors. There's 3 years for stamp duty and 6 years for capital gains tax. Or corporation tax. I would be very careful before you do that, assess it. I would just keep the group in place and then go again doing the same structure, unless you've got a risk of some sort. You may then use another SPV to buy a freehold and then use potentially the same subsidiary B to do a split. But I'll also be careful about risk, which is slightly different conversation, because it may work from a tax perspective, but if you go to a financing organization, they don't like a lot of flats in one area. They don't tend to give you financing. They've got different rules, which I've seen from clients, around how much coverage they want, on how much you can go to one financing organization. So you've got to be very careful how you do this. Yes, you may pay more accountancy fees and you may need advice around tax, but it's worth it if you're making the uplift and you're getting the revenue generated from the split and the rental income. Does that make sense?
Yeah, absolutely.
So hopefully I've covered, it's a bit of a technical question there, and I'm sorry if I've gone a bit technical, but I'm trying to give you the things that you've got to think about, why you need specialist advice. And Ronix asked an amazing question, because he's from a bit of an accountancy background and he's structured in that way, so people who haven't from that, get advice before you buy it. Go back to that. Does that make sense?
Absolutely.
Perfect. Is there any other stuff that you've got? I'm not here asking this because we get this value, because the entrepreneurs that are watching this, or potential entrepreneurs, they love these questions.
No, I think that's it. Yeah.
Perfect.
Yeah.
Thank you so much. Another person, and this is what the value gets, SSAS London. Dan Torres, are you watching while you're on holiday? We're adding value to your event, and I hope you're loving it, and I know many others are doing as well. Thank you so much.